Okay, I just wanted to make a quick video on what an SMT divergence is. I had a couple people in my Discord and on social media asking how I use it, and I'm just going to show you guys what SMT divergence is and how you guys can learn it and how you guys can identify using it in the market. So I got my chart up here. I'm just going to draw it for you guys to make it a little bit simpler, but let's start off with what even is an SMT divergence. An SMT divergence is when you use two indexes, and I personally just used S&P 500 and NASDAQ. That's all I use. I don't know if you guys could use it with Forex or crypto pairs, but personally just me. I went back and back tested it. I've seen a lot of stuff on social media also of other people learning, teaching it, so I could learn it, and it works best for me on NASDAQ and on ES. So this is what I'm going to be demonstrating for you guys. If you're going to use it, I recommend using it on the same stuff as me. If you want to go ahead and go test it on the Forex markets or crypto, that's totally up to you. But personally, it just works on NASDAQ and ES because that's all I trade. New York session every single day, and that's about it. So with an SMT divergence, we're looking for the lagging index. So when we get into it, right now I'll just give you a quick rundown. Let's say that market opens up, we come out, take a draw of liquidity out. So let's say we take out buy side liquidity, and let's say NASDAQ creates a higher high, a high and then a higher high, and then ES creates a high and then a lower high. In that case, NASDAQ would be the lagging index, and what we would do is take the trade on NASDAQ and look for, we scale down the lower time frames, look for confluences, and take the trade on NASDAQ, because with the SMT divergence, we could see that ES is ahead of NASDAQ a little bit, and it kind of helps us predict the future a little bit. Again, all this stuff is not 100%, guys. That's why we scale down and use the lower time frame too to get our entry. But most likely that means that NASDAQ is lagging behind ES after we swept out liquidity, and then we're going to continue lower to take out our sell side liquidity. So to get into what I just said, because that was probably a little quick and you guys don't understand what it is yet, I'm going to draw it out here for you guys. So as we can see, so let's say this is NASDAQ. We're coming up, we form a high, and then we form a higher high, let's say, right? This is NASDAQ. I'll zoom in here. My drawing is a little terrible. And then let's say ES forms a high and then a lower high, just like this. Okay? If you guys could tell by this shitty little drawing. But here, let's just X this out real quick. We're not going to do the drawing tool because I suck with it. We'll just do this. So let's say this is NASDAQ. We come up, we form a high and then a higher high, right? And then we'll get ES. ES, we form a high and then a lower high. So in this example, let's say this is NQ. We'll put NQ and then we'll put ES. All right, so this is going to be a bearish SMT divergence. All right, so what we're going to do here, so NQ created a high, right here, and then a higher high. ES formed a high and then a lower high. Let's say we were coming up on a draw on liquidity, because you're not just going to use SMT divergence randomly in the market. I use them off draws on liquidity, like high time frame draws on liquidity or high time frame fair value gaps, and I look for price to enter those areas, see if we get a reaction off. Then we'll scale down to the lower time frames, see if we can get an entry, and then we take the trade from there. But let's go back to the SMT. Here we have NASDAQ created a high and a higher high. ES created a high and then a lower high. In this case, this is a bearish SMT. NASDAQ would be the one lagging because ES is showing that the market has the potential to continue down, especially if it was off a liquidity sweep. So let's say we had a high time frame draw on liquidity up here. Let's erase this one out for NASDAQ. We'll do this. Let's say we had a high time frame draw on liquidity right here, right? NASDAQ comes up, takes it out. ES forms that high, but forms a lower high, and we don't take it out on ES. This shows us that NASDAQ is lagging behind it. Then we'd scale down into the lower time frame. So let's say this is on the 5 minute. We'd scale down into the 1 minute, look for a break of structure, a fair value gap that gets respected or equilibrium, and then we take our entry. And that would be to the downside because this is a bearish SMT divergence. And let's also not forget this, guys. SMT divergence can work on any time frame. It can work on the 4 hour, the 1 hour, the 30 minute, the 15 minute, the 5 minute, and the 1 minute. I personally don't use SMT Divergence for the 1 minute because I feel like that's too low of a time frame. But I pretty much use it all the time. As you guys will go back and look at my trading recaps, and if you watch me trade live on my Discord, which happens Monday through Friday at 9:30 a.m. Eastern time, I trade New York session every single day. You guys will see me use these same confluences, especially when I see an SMT Divergence, to mark out how I'm going to take my trades and see if I take a trade, if it works out in the correct direction. So again, this is a bearish SMT Divergence. And it works either or too. So even if ES was opposite of NASDAQ, so let's say ES created a high and a higher high, and then NASDAQ created the high and the lower high, then ES would be lagging. It can happen in both scenarios. It doesn't just have to be one market. So again, let's recap over that. A bearish SMT Divergence is when one index, right, out of the S&P 500 and ES, ES and NASDAQ, sorry, one forms a high, then a higher high after a liquidity sweep or coming into a high time frame fair value gap. And then the other one creates a high and then a lower high. And the one that is lagging is the one that creates the higher high. And then we'll scale down to lower time frames and most likely take a trade off of the lagging index to the downside in this occasion. So same thing happens with a bullish SMT Divergence. So now we'll switch it up, like I said. Doesn't matter what index. So let's say NASDAQ forms a low, and then we come back up and form a higher low, right? This will be a bullish SMT Divergence, so I'll make this green for you guys. And then ES comes up, and it goes down, so we'll form a low, and then we form a lower low, right? So let's say same thing. We'll go off withdrawal and liquidity here, right? Do this other one, sorry. So let's say we have a 4-hour low below, right? Market opens, we have a 4-hour low. And it's not too straight for you. But as you can see here, I'm going to give you guys a quick little quiz. Which one would be the lagging index here, right? NQ formed a low and then a higher low. And then ES formed a low and a lower low with taking out the draw on liquidity. It could still happen too. If we took out the draw on liquidity with NQ like this, so let's say we formed a low and then a lower low and we still took out liquidity, ES is still the lagging index, right? Because NASDAQ formed a low and then a higher low, showing us that price has the potential. And that's my dog and my girlfriend in the background. There you go, making all the noise. But sorry about that. But back to what I was saying, ES formed the low and then a lower low, showing that price is lagging behind NQ because NQ is showing that we have the potential to move to the upside after taking out a draw on liquidity. We would take our trade on ES, scale down to the lower time frame, like the 1 minute, if this is on the 5 minute, and then we look for a break of structure, a fair value gap or equilibrium get filled or respected, and then we would continue our price to the upside. So it is pretty simple. It's as simple as I'm trying to make it sound. I'm trying to make it sound as dumbed down for you guys as possible. Again, I started this YouTube channel about, I think, 4 months ago, and the more I teach you guys, the better I'm going to get at explaining this stuff. I'll make more videos about this stuff in the future, but this is my first video on SMT Divergence, so I'm going to try and explain it to you in the best way as possible for you guys. So I marked out one of the trades that I took on Friday. I actually lost this trade, but I spotted an SMT Divergence, and I'm going to go over that for you guys to show you a live example in the market. And again, if you guys want to see me use these confluences, I trade every single day, Monday through Friday at 9:30 a.m. New York time, Eastern time for New York session. I trade every single day. I call out my confluences, everything. I call out my trades. You guys can see me use this live. But right now I'm just trying to show you guys a simple breakdown of what SMT Divergence is so you guys can get the understanding of it, go back and back test it, and see if it works well for you guys. So we'll go to a live example that happened on Friday of this week. And this was on the 5-minute time frame. Scale down here for you. All right, so as we can see on the 5-minute time frame, change this to the 5-minute. All right, as we can see on the 5-minute time frame here, right? We had our draw on liquidity that got swept out by NASDAQ, right? Right here. And then we had it on ES, which didn't get swept out, as we could see, right? As we could see, NASDAQ created a high and then a higher high, and ES created a high and then a lower high. So in this case, right, I'm going to give you 2 seconds. Which one would be the lagging index? If you said NQ, you're correct. If you said ES, you might be a little bit retarded. I'm just kidding. I'm just joking. No, it is what it is. The lagging index is going to be NASDAQ on this one. You're not retarded. Dude, this took me... Learning SMT divergence in the live market took me freaking a year to learn, so it takes some time. But in this case, NQ will be the lagging index, so this is where we take the trade off of. So look, this is on the 5-minute time frame, right? Just to show that this works. This is literally Friday of this week, of last week. So we'd go down into the 1-minute time frame, right? We'd go down to the 1-minute time frame. What I would look for is a break of structure. Do we get a break of structure on this candle? Nope. Do we get a break of structure on this candle? Yep. So we get a break of structure. We don't get a fair value gap, but we get equilibrium. We mark out from these highs to these lows. And I have a video on equilibrium. I have a video on how to identify liquidity. And I also have a video on break of structure. If you guys go back on my YouTube channel, you guys can find them. If you guys want me to make more of them, I can make more for you. Again, I just started this channel about 4 months ago. I started it this year. The more I teach, the better I get at explaining this stuff to you guys. But just in general, if you guys don't get enough information from the last videos I made on my YouTube channel, just comment below and then I'll make another video for you guys explaining it better, because over time, again, I get better explaining this stuff to you guys. But as we can see here, we had a break of structure and then we had equilibrium. Price comes into our discounted price range. We get a big candle out of it, showing selling pressure out of it. I would have took my entry off of here, put my stop where equilibrium gets invalidated, and then I'd target our sell side liquidity down below. We had this draw on liquidity. This could be a take profit level. This could have been a take profit level, this low. And then this could have been your final take profit down here, which all 3 of them would have hit. And that would have been a 3.32 risk to reward on that trade. And it just shows you that the SMT divergence can work. But that's just a quick little example that I wanted to go over because I remembered that this happened on Friday. Again, I recommend going back and back testing this and just taking your time, trying to learn it. Remember, guys and girls, if you guys are watching this, you'll see an SMT divergence. You don't just randomly take it. We want to take these off of high time frame liquidity sweeps, high time frame fair value gaps. You could take them off high time frame order blocks. And you got to remember, you have to use SMT divergence with your high time frame bias also. If you're bullish on the 4-hour and the 1-hour and you see a bearish SMT divergence on the lower time frames, you most likely won't want to take that because your high time frame bias is telling you that it's going to go in the up direction instead of down. So you got to remember to use your high time frame bias with this stuff. Go off of high time frame draws and liquidity or fair value gaps or order blocks. You scale down to the lower time frames, look for your other confluences, your continuation confluences, and then you look for your break of structure, your fair value gap, your equilibrium. Find your entry on the lower time frame, and then you execute your trade and see if it plays out in your way. Again, this is not going to work 100% of the time. This is trading. That's why we have a risk management system, but it gives you a higher probability of the trade going in your direction instead of going in the opposite direction. And that's why we have all these confluences to help you guys identify to get a higher probability to take a trade and become successful on it instead of it playing out in the other direction. But again, it is the stock market. It is going to do what it wants to do. We take trades off of high probability setups. We execute, set our risk management system, and then we see if the trade plays out, and hopefully it does in our favor. So again, hopefully you guys learned a little bit in this video. I know I didn't explain it probably too well, but I'm going to make another video for you guys in the future. Go back and rewatch the beginning so you remember, or write it down in your notebook or whatever you do. Write it down in your notebook. Make sure you know what a bearish and a bullish SMT divergence is. Go back and back test it in FX replay or in the charts, or just take fake trades or on demo accounts and stuff when you guys are seeing these play out. If you don't know them, take demo trades while you're watching the live market if you want. Totally up to you guys. I don't just recommend jumping into the markets right away saying, oh, I see an SMT divergence, let me just take a trade. You got to remember, you got to use this stuff off high time frame bias, high time frame liquidity, high time frame fair value gaps, scale down to the lower time frame, use your continuation confluences, then get your entry. It's just not, I see an SMT divergence, enter a trade, it's going to play out. So again, hopefully you guys learned a little bit in this video. Hopefully this helped explain what SMT divergence is a little better for you guys. If you want me to make another video to explain a little bit better, I can. Just let me know, comment down below. But like and subscribe these videos. I want to keep this YouTube going for a long time. I want to grow it as big as possible. I'm going to keep getting the educational videos out for you guys. I'm going to keep getting the trading recaps out. I'll keep doing the live trading in the free Discord if you guys want to do that. Link is in the bio. And we're going to keep growing on Instagram, YouTube, TikTok, and as a trader in general. So hopefully you guys enjoyed again. Like and comment. And let's get after it this next week. Appreciate it.